given it's the lunch fair, and this isn't a regular part of my job, so I thought I would give you a lot of pictures and so forth. Given that I am in the math department and pay homage to the great minds of mathematics, this will be a non-quantitative explanation. Okay, so these pictures come from a 1984 movie, Gremlins. Okay, that was one of the early sci-fi movies that combined a little bit of the giving tree that we see in today's movies. Okay, but the idea is that as you build your financial models, often deep below the surface of these financial models are assumptions that contain gremlins. Okay, sometimes they might be oversights. In this case, sometimes they might be the result of just faulty research. Just didn't talk to enough people. You didn't dig deep enough, and so the gremlins appear. Yeah, very devastating result. And you'll also be pleased to know that this research, or this little lecture, comes not just from years of research and teaching in finance, but also from personal investing experience. Okay, so, and as well, experience with the Laurier Student Investment Fund, where I've read over many students' reports over the years. Okay, the first gremlin is students don't really understand how the company makes money, okay? How it generates its revenue. And what you really like to do is actually look at how the customers are invoiced. So you pay for many things, such as in this bracket, you get an invoice. You might pay for your Bell bill, and that's really hard to understand, or your cell phone bill, many of the suppliers. That's really hard to understand. Okay? So companies that you analyze are invoicing other companies for their services and for their products. So it would be really nice to have the details on those. But however, as an analyst to many public companies, you have just a vague, often they just have a 10,000 feet view of the revenue generation. So you really don't understand the model until you watch the company over time. And that's what I believe happened in the case of Guess Logics with some of our analysts. Guess Logics offers the credit card processing that you will see on most North American, European, and some Asian airlines. Okay, so when you go and buy a soft drink, you can't use cash these days, WestJet or Air Canada. You have to use your credit card. Okay? And so the company that processes your credit card is called Guess Logics. Okay? You think that would be a moneymaker. They have a dominant share of each market. They have, in fact, in some markets over 50 to 60%, so they are a dominant player. However, to sort of develop their business quickly, they signed a lot of contracts whereby you had to arrive up to a fixed dollar amount of sales, whether purchases of pop or different items on board, of your customers on the airline before that airline was billed for more. Okay, so let's say they charged Air Canada $1 million a year for providing the services. That would be $1 million a year until the value of all the transactions on Air Canada's flights that use these processing equipment reached, say, $80 million. Okay? Well, analysts learned that those contracts were set at higher levels and the company wasn't able to achieve those levels until longer dates. In fact, they haven't achieved those levels under most of their contracts. So what they have is they have these rising levels of transactions and they have level income. So underneath you all, you have people using these credit cards more and more, you have them buying larger amounts, but it hasn't translated into Guess Logics making more money. So our analyst on the fund, if you look embedded in his model, he used a fixed percentage, okay? So as gross transaction size increased with Guess Logics winning more airlines, as they reported, the revenues went up. But he was surprised because when the reports came out, you had 30% increase in gross transactions, but 0% increase in revenue. So that was not necessarily his problem became our problem, but it was a problem that was hard to identify at the beginning because the company didn't disclose these actual dollar levels. Okay? So whenever you're dealing with a newer company, a company when you don't have a good understanding of how it actually bills its customers, you run into this risk, this gremlin here. Okay? And often tech companies do this to gain market share quickly, right? So Air Canada says, yeah, I'll sign you up, $1 million. I've got a fixed cost here. I'll help you get started. And you think this technology is so good? Okay, let's set the amount at $80 million of transactions. And after that, we'll pay you some more. Right? So you can't just take these formulas. The formula has to be more complicated. Okay? It has to reflect the real invoicing practices. Any questions on that? So there are many, many cases. Okay, that's your first task if you really want to do some fundamental analysis about a company. And that's what makes early stage companies really tricky, is because they don't necessarily disclose. It's not obvious what the relationship between some of the, what you think to be revenue drivers, like purchases by passengers in an airplane, and this company's revenue. Okay, gremlin number 2. Often when we do a discounted cash flow, we have our best guess. We might do some scenario analysis that takes a worst case, best case. We might even do some Monte Carlo simulation. But you've really got to be aware of how risky it is to have a company that's bleeding cash for a length of time, especially a startup company that needs lots of money to get itself in order. So we had a company, and it was covered by a very smart student who now works for Fidelity. His name will go, well, actually he did work for Fidelity in the recent days. And he was working for another firm, so he's a very bright guy. He made a lot of impact on the fund because he had 2 or 3 other companies that really did well that he recommended and he analyzed. This company, however, was a little tricky, a little bridge too far. What they did is, about 8 years ago, they sold voice over internet protocol services to businesses in the 5 to 100 line range. So if a business, say a real estate broker, had 25 agents, if they wanted to have those lines changed, because agents often change, or you're expanding your brokerage, so you need to have additional lines put in, you call Bell Canada, it's a big hassle. So going voice over internet protocol, you just sit down at the terminal, it can be arranged seamlessly without paying those Bell charges. Perfect. However, to convince a small, medium-sized business person to take on this service, in addition to their standard carrier, is a lot of work. You got to get on the phone, you got to get their attention. Many of you have received calls at home, but business people also receive calls, right? Buying calendars, pens, credit card equipment, processing equipment. They get all sorts of calls, right? Just talk to your barber or hairdresser and you'll find out the kind of calls they get, okay? Yeah, okay, so the analyst believed that the sales would ramp up fairly quickly. He basically modeled them like a sales-driven organization. You hire so many salespeople, that translates into so many sales, because they have so many calls that result in so many hits, okay? And they had a number of managers who had experience in developing sales teams and from the major carriers. The problem is that they did not achieve the rapid sales growth and therefore the rapid positive cash flow. They had negative cash flow for a longer period than they thought. What do you do if you're a early stage tech company? You can't go to the bank. You have to issue equity. So they diluted themselves to death, okay? In the space of 8 months. Okay, so, yeah. Often in the excitement of some of these early stage companies, great concept, okay? But if you don't have a means of getting the cash without diluting your equity, you're going to do harm to your current shareholders. Any questions on that? The third gremlin is that oftentimes, and this frequently occurs at the time of IPOs when the investment dealers help time the offering of shares to be most attractive to the investing public, or having an excellent sales pitch to carry to the market, people will base their estimates on a very short time frame. Okay? And that time frame reflects sort of an optimal period. There's a company down in Cambridge, ComDev, that makes satellite equipment. And it was founded by a very bright guy, who in turn was a major angel investor in RIM, okay? Val Donovan, and I believe a donor to the school here. So, yeah, he actually sold out some of his holdings in the company soon after the IPO, which is also a signal that you might want to fail too. So, if you're an analyst looking at this company and you just took the prior year's results, pre-IPO results, because oftentimes they'll make these IPOs difficult to analyze because they might combine 2 or 3 different companies, there might be a complicated capital structure. It's often difficult to get a long period of history. So you're left with this very short time frame with great sales growth and high margins. Problem is, if you go further back into a company like this history, it's a satellite equipment maker. They make equipment, they have long-term contracts. Typically they're fixed price contracts, which means they have cost overruns from time to time. The company has significant losses every few years. Okay? That's the history of this company. And the history of the company continued after the IPO. Great year, first year IPO, bad year, 2 years after IPO. Good years, bad year. So the stock price never really was much higher, for any sustained length of time than the IPO price. There is some academic evidence that indicates that stocks post-IPO, especially in periods of market exuberance, where there's a lot of new offerings, they tend to underperform longer established companies. Okay? But these kind of companies are getting pushed by some of your future employers, the investment dealers. Okay? Now, the other problem I see that's quite frequently encountered, now, I see this among students. I'm hoping that people in the industry don't do this as much, but for your own sake, when you start out, be aware that when you conduct analysis of a company's historical performance as a basis for, say, margins, you want to figure out the gross margins, the percentage of sales, so you look back 5 years. What students often do is they do not remove exceptional items, exceptionally on the positive side, nor on the negative side. It's hard, right? You got to dig in, read the old statements carefully. For example, in this company, Goodfellow, it's a lumber supplier in Eastern Canada. And of course, if people are renovating their homes, they're buying lots of hardwood lumber. Sales are high, margins are good, and however, what that type of stimulus does is it brings sales that might have occurred in 2012-13 forward. Okay? And then after that, the sales and margins drop off. And that's what happens. Okay? But so one of the analysts was very excited about the stock, and the excitement occurred in this particular period of time, but I don't think he recognized that it was a temporary type of boom. Other times